You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview.
Sounds good.
Hey everyone, welcome back to another episode of Market Champions. Today I've got Louis-Vincent Gave. So Louis-Vincent Gave, he's the founder and CEO of GaveKal. So Louis, thank you so much for being on the podcast. It's phenomenal to have you on.
It's a pleasure to be here. I don't know about being a champion, but I'm unless the champion is you.
But no, it's you.
I'm very happy, very happy to be here.
I mean, champion is your middle name, so it should be Louis.
Yeah, no, hardly. Yeah,
so,
and
I mean, Louis,
as I get older, I like one.
So, Louis, let's get started by talking a bit about your background. So, could you talk a bit about how you got into finance and your journey to finding GaveKal and to get to where you are today?
Sure. Well, again, first, thanks so much for having me. So, I started my financial career as a financial analyst at a French investment bank called Paribas. And before joining Paribas, I'd actually lived in China, studying Chinese at Nanjing University in the mid-90s. And I was lucky enough that just as I joined, Paribas had decided to buy an Asian broker called Asia Equity. And so they looked around the firm and they said, "Oh, Louis, you speak English pretty well and you speak Chinese. Why don't you go over there and work on the integration of this new broker?" So initially I went up to Singapore and then to Hong Kong. And I was sent, literally as the Asian crisis was about to start, which was, as a young person starting in finance, was a terrific formative experience. I mean, it was hell as you went through it. And the business that Paribas had bought ended up basically imploding in front of our eyes. But it was a transformative period for Asia, and it was very great to have a front row seat on that. And then what happened with the Asian crisis back of the late 90s was that most Western investment banks decided to cut their research budgets, cut their staff, pull back from Asia. And so by the early 2000s, you had this sort of odd dynamic whereby there were very few Westerners still covering Asia. And at the same time, it was getting pretty obvious that Asia was going to be, and especially China, that was in the process of joining the WTO, was going to be really, really important. So I set up my own business called GaveKal with basically this idea, very simple idea in mind, that there was a sort of niche product market to capture because China was going to be very important and people's understanding of it was fairly minimal. So it was really a question of being in the right place in the right time. And then when we launched, I was joined by my father, Charles, who'd been a very successful money manager. Had created a big money management firm in the 80s and 90s and sold it to Alliance Capital and then had retired. And then by a friend called Anatole Kaletsky, who was a financial journalist. So initially we were really three men and a dog. I'd bring my dog to the office, and over time, like I said, we're in the right place at the right time. China grew, we grew with it, and as we made money, we kept investing down the Chinese wormhole. We opened a business in Beijing, invested in other businesses in China, and then also built up a money management firm. So that GaveKal today, the business I run, is it's a mix of a research business, and we publish research that we sell to institutional investors around the world, and a money management business. So that's roughly who we are.
Yep, got it. And I wanted to start talking a little bit about let's start talking about China because you mentioned it. And so recently we saw the PBOC cut the prime rate, we started seeing some trouble when it comes to the Chinese mortgage market and the Chinese property market. Now, what are your thoughts and how are you thinking through what's going on in the Chinese real estate market?
I think look, there's a real problem in the Chinese real estate market. After sort of 20-year massive bull market, you're definitely hitting a massive hurdle. And I would say that the real problem, the source of the problem, is partly the way real estate is financed in China. So very briefly, the way it works is that if you want to buy an apartment, you're going to put 20 or 30% down with a property developer, and that 20 or 30% will represent all of your life savings. Maybe even you'll have borrowed from friends, borrowed from family to make up that 20 or 30%. The property developer takes that money and then goes out and borrows money from the banks to start building. So you've given the property developer 20 or 30% of your money, and the idea is that in 18 months' time or 2 years' time, you'll get an apartment. And the way the property developer does that, of course, is by borrowing against that 20 or 30%. Now, what you're going to do is when the apartment is ready to be delivered, you yourself are going to borrow whatever, 70%, the remainder, to pay the property developer. So in essence, the bank lends to the property developer, then it lends back to you, and that pays back the loan from the property developer. Now, the big problem is that a lot of property developers have been going bust. And as they go bust, they wipe out that 20 or 30% life-saving deposit from a lot of people. And this has created a sort of systemic risk where nobody wants to buy real estate anymore because of this fear. So it's not dissimilar to the situation you had in the 1930s in the United States. When banks started to go bust, nobody wanted to keep their money at the bank out of fear that the money would just disappear if the bank went bankrupt. It's sort of the risk that we saw with Lehman when people started in the Lehman crisis, when people started to fear for their deposits in the various banks. So the answer is pretty simple, right? You could say, well, just as in the 1930s, the US built an FDIC, in China, you should build some kind of insurance company that insures the deposits that people put into real estate developer. After all, if I buy an apartment from Evergrande and I give up them all my life savings and then Evergrande goes bust, it's hardly my fault. I'm not supposed to be able to read, if I'm Joe Public, I'm not supposed to be able to read Evergrande's balance sheets. I mean, even financial analysts can't read Evergrande's balance sheets, let alone the average guy on the street. So this is obviously what needs to happen. Now, part of the problem is one of timing. As you probably know, we're a few months away from the Chinese People's Congress.
Yeah.
So right now, what's happening in policy circles in China is everybody's trying to position for the next jobs, planting knives into each other's backs. And nobody wants to stick their head over the parapet and propose a big policy reform. This is not, in a sense, it's a little bit, we're in the same, if you remember the 2008 Lehman crisis, you weren't there, but in the 2008 Lehman crisis, it occurred, everything started to unravel basically just before the US election, and everything unraveled before Obama was sworn in, where you have, the sort of couple months in the US where you're in between two administrations and nobody knows who's making decisions, and it's hard to get anything done. It's a little bit like that in China. I mean, it's a bit of a stretch in terms of the parallel, but that's the general idea. Right now, for the next couple months, nobody's going to make any decisions. So you're left with the only person that can make the decision is indeed, as you pointed out in your question, is the central bank. So the central bank can cut interest rates. At the same time, the PBOC is probably the only hawkish central bank on inflation left in the world, partly because Chinese policymakers worry more about social stability than other policymakers anywhere around the world, and inflation is a great social destabilizer. So putting it all together, here we are. You're in this situation where for the next couple months, everybody will be waiting for the People's Congress to see what kind of measures they adopt to stop the rot in real estate. And for me, the measure that needs to be adopted is a pretty simple one: is create for lack of a better word, an insurance scheme that allows the property deposits to not be wiped out.
Mm-hmm. So in a way, would that be similar to what the US did post 2008 with TARP, and basically said that whatever crap the banks have on their books, that is the Fed still sort of accepts that. Is that sort of what you would propose?
No, because I don't think it's the same issue. The reality is, when it comes to crap on the bank balance sheets, it's there. It's been there for years,
Right?
And it doesn't really matter because you have massive regulatory forbearance in China. It's the amount of crap there is on the bank balance sheet. At the end of the day, most of the banks are, or at least the big ones, are state-owned. So the government isn't going to come in and say, "Hey, Agricultural Bank of China, you can't mark these at 100. You got to mark these at 60." That's not going to happen. It never has happened before, because the government doing this, they'd be shooting themselves in the foot. So I think using the 2008 templates of the banking crisis in the US and applying that to China is misguided.
Right.
This isn't to say you can't have a crisis in China, but it's just going to be of a different nature. The crisis you have in China today, I think, is a crisis of, you have property developers that are going bust because they've overextended, because they paid the wrong price for land, because they sold properties at a certain price at which they can't produce it anymore, because price of steel has gone up, price of commodities have gone up, etc. So for a host of reasons, and against that, nobody wants to buy real estate until you have more visibility as to which property developer survives and which doesn't.
Mm-hmm.
So I think it's not so much 2008,
Right.
perhaps more the 1930s, where in 1930s, people were worried about the safety of the bank, right? And people had their life savings in banks, and they were worried the banks were going to go bust until the FDIC came in. Well, today people have their life savings in real estate, and they don't want to put money with a property developer who could be bankrupt tomorrow.
Right.
And it's very hard to know. It's very hard to know which property developer is safe and which one isn't, given that the old rule of thumb in China was always bigger is better, right? That size. Like if I go with Evergrande, surely the government isn't going to let Evergrande go bust. That was sort of the mantra, that if you got to be big enough, the government would always back you up in a crisis. But this has proven to not be true in this cycle.
And did that sort of surprise you, in the sense that they just let Evergrande go bust and they sort of didn't step in to save it?
I think they've been telegraphing it for a while. First, Xi Jinping, I don't think it was surprising. You saw Xi Jinping go after Alibaba head on, right? And Alibaba is about as big as it gets. And not being afraid to take that on. I think quite the opposite. I think what we've seen in China in the past few years is a move from big is beautiful to small is beautiful. For most of my career, if you were a Chinese business, you wanted to get as big as quickly as possible, because it meant that indeed, when there was a downturn, you'd be the one with access to bank credit, or you'd be the one that the government would bail out, etc. And I think in the past 5 years, it's been very clear that this is no longer the case. Partly because it created too much moral hazard. It created the wrong attitude. It meant that every business out there was always doing excess capital spending, and you were growing for size's sake, not for profit's sake. And so now and I think this became very clear with the Alibaba crackdown. What was it? A little over 2 years ago now. And I remember having this discussion with our mutual friend Mike Green on this, on his own podcast for Real Vision. You've moved from you have to be as big as possible to you want to be small enough that you're under the radar and the government isn't going to come for you. The bottom line is, in China, you've moved from the government is your friend to the government is not your friend. And by the way, I would say that's probably the case everywhere around the world, not just China. one of my big themes in my research is that nowadays trends start in China and continue elsewhere. But the reality is, if you think of an inflationary environment versus a deflationary environment, in a deflationary environment, the government is your friend because the government will protect your margins, and will help you in downturns, etc. In an inflationary environment, look at what's happening, for example, for the French and German electricity companies today. Price of electricity goes up, and the government tells the electricity companies, "No, sorry, mate, you can't pass that on. You got to eat that. Eat it into shareholder capital, because if you pass that price increase, I'm going to have revolution on my street on the streets." And then the companies say, "Yeah, but I don't have enough shareholder capital." Okay, then declare bankruptcy. So what I mean is, in an inflationary environment, the government becomes an enemy, not a friend. And so you saw that in China starting 5 years ago. Government putting pressure on companies, squeezing their margins, etc. You're now seeing it all over the world. Just like every trend, it starts with in China, and then it moves on.
Yep. And I think what else is, because recently you published a piece titled "The Questions That Matter" for GaveKal Research, and in that, you sort of highlighted that one of the other questions that's going to be very interesting to watch as the CCP's upcoming Congress comes up is whether Xi Jinping ends up being ruler for life. So how do you think that would play out if Xi Jinping ends up being ruler for life? What are the dynamics involved, both from an investment standpoint as well as from a political risk standpoint?
Yeah, look, I think when you look at Chinese markets and the level of outflows over the past year, both from equities and from bonds, and the Chinese bond markets, when you look at the level of outflows, it's pretty clear that foreigners have, for all intents and purposes, given up on China. And this could be for a number of reasons. I think first and foremost is the fear of a China invasion of Taiwan, which would lead to, financial upheaval similar to what we've seen between Russia and Ukraine. So that's probably the number one reason. And then number two reason is, the continued COVID lockdowns and zero COVID policies and the tech crackdown and the real estate slowdown that you and I have discussed. I mean, there hasn't been a lot of great news coming out of China for the past year. And indeed, amongst the worrying news, if you're a foreign investor, is that if you think of China's history, basically from 1949 onwards, China had one-man rule, right, with Mao Zedong. And then when Mao died, the Chinese Communist Party got together and said, well, let's not do that again, because that was a bloody disaster. So let's basically manage by committee. And so China basically moved from one-man totalitarian dictator to this sort of authoritarian technocracy, where you had management by committee, which, as you and I are citizens of democracy, so we can look at that as a vastly inferior system to democracy. But if you're Chinese, it's vastly superior to dictatorial one-man rule. In the whole scheme of things, if democracy is up here and one-man rule is down here, management by an inadequate technocracy is in the middle. And so this is where China was. And I think in recent years, the fear has grown that China is reverting back to dictatorial one-man rule. And we've just seen in Russia what that can lead to, right? And so the fear is, oh, well, if there's no more checks and balances on Xi Jinping, does that mean you get a Taiwan invasion? Does that mean you increase the risk of policy mistakes, so on and so forth? I think that this has triggered massive outflows, and this has made for pretty poor performance of Chinese assets. Except Chinese government bonds, in the face of these massive outflows, have actually held up very decently. They're roughly flat for the year, which is a massive outperformance against U.S. Treasuries. Having said all this, we have this party Congress, and this is one of the big questions for the party Congress: is does the Congress confirm Xi Jinping for life, option one, and say Xi Jinping is the best and brightest amongst all of us and will always be, so we'll give him a mandate forever, option one, or option two, say, okay, Xi Jinping gets one more term, but in 5 years from now, this guy is going to be the new chairman and this guy is going to be the new premier. it could go either way, and nobody knows what goes on in these internal discussions in the Politburo. What I do know is the market is very much priced for the first scenario.
Right.
Basically, Xi Jinping dictator for life. So if you get it, I don't think the market responds. I think it's already priced in. If on the flip side, it comes out and, oh, by the way, in 5 years' time, this will be the new team, the markets will breathe a huge and massive sigh of relief. And you'll move from China being uninvestable to potentially China being investable again. I would then expect a big rally in the renminbi, a rally in industrial commodities, a rally in the various emerging markets, and basically all the various China derivative plays, and of course in Chinese equities themselves. But again, I have, anybody who tells you they know what's going to happen is lying. Like, unless you're sitting in yourself in the Politburo, the reality is nobody knows. So we'll just have to wait and see which way it is, and be ready in case a positive outcome comes out of the party Congress.
Mm-hmm. Got it. Yeah. And sticking on that theme of China for another minute, compared to when, and yeah, I remember before we started the podcast, you mentioned that you're potentially going back to Hong Kong. But when you started being when you were initially a resident of Hong Kong versus now, how has your perspective changed on sort of the role of Hong Kong, especially within the Chinese system?
That's a very good and very tough question. So Hong Kong has evolved, of course, dramatically over the past 25 years since I first moved there. But then I think you take any 25-year period, Hong Kong has always evolved. It's a city built by immigrants with a dynamism and an enthusiasm that you're not going to find anywhere else. It's the only place you find similar to Hong Kong in terms of the energy you feel when you land there, I would say, is New York. But frankly, Hong Kong for me is New York on steroids in terms of the energy it provides. And so, look, I think for years, Hong Kong played a dramatically important role for China, in that it was, of course, China's capital market at a time when China needed a lot of foreign capital to grow. It needed a lot of intellectual capital, it needed financial capital, and Hong Kong provided a lot of that. The big question is today, China's running $100 billion trade surplus. It doesn't really need foreign capital all that much anymore. It really doesn't. Hence perhaps the no longer the need to do many compromises when it comes to Hong Kong. Now I also think Hong Kong has not been very well managed it's actually been poorly managed for the past 20 years, mostly because it was managed for the status quo, and it was managed by civil servants, not by politicians. It was managed by civil servants. The whole Hong Kong government was basically run by civil servants who were more inclined to try to preserve the existing status quo and not piss anybody off, partly because they were in the uncomfortable situation of having two bosses. Here's some career advice: make sure that whatever you do, you only ever have one boss you report to. If you have two bosses you report to, like the Hong Kong government that has to report to the Hong Kong people and to the Chinese government, when the two bosses don't get along, that leaves you in a tight spot. Now, when it comes to the Hong Kong government, I think again, part of the problem, 25 years ago, when Hong Kong, got back to China, Beijing was happy to let Hong Kong be managed by Hong Kongese. It had enough trouble on its plate. It had enough things to do. It's like, well, if you guys manage yourselves, sure, as long as you don't create problems for us. And then once you started to see the Yellow Umbrella Revolution and then the Student Revolution 4 years later, the Chinese government felt, well, then I've got to get involved. This is a mess. You guys obviously can't seem to handle this. And since then we've had curtailment of civil liberties. We've had the crazy COVID response that we've seen,
right?
And all of that has made Hong Kong a far less attractive place to live, mostly for almost everyone, but definitely for expats. And so the big shift that you're now seeing is most expats leaving. moving to Singapore, moving to Dubai. I'm still hopeful for Hong Kong's future, though, partly because Hong Kong has been through crises before, partly because Hong Kong does have a history of reinventing itself,
Right.
and partly because, yeah, it is a country of immigrants who, don't sit around on their asses thinking, oh, how terrible this is. They'll get up and,
Do
make
something
it
about it.
work.
Yeah.
They'll do something about it. They'll make it work. They'll adapt. And so, yeah, Hong Kong's going through a tough phase. But the reality is China is still the second economy in the world, and Hong Kong is still the capital market to the second economy in the world. And there is a room for that. There is a room for that. So I'm still hopeful that in 20 years' time, Hong Kong will be a good place to live.
Awesome. Yeah, no, that makes sense. And I love your optimism when it comes to Hong Kong. The other pressing concern that people think about when it comes to China is the prospect of a conflict with Taiwan and would potentially be a US response. So, if China were to invade Taiwan, how do you think that would play out? Would it be something similar to how the Ukraine war played out, in the sense that to Russia, while it was, at least in theory, far stronger than Ukraine, it sort of ended up in something close to a stalemate when it comes to what's going on in Ukraine? Or do you think, China, a win would be quick and decisive over Taiwan? And also, to make the question even longer, what do you think the US would do in that sort of a situation?
Okay, so first things first, I think it's very different from the Ukraine-Russia situation. It's very different militarily. It's very different legally.
And strategically.
And strategically. There's so many differences. But let's first start off with the militarily. Ukraine is a bunch of planes. It's easy to send a bunch of tanks and artillery and cannons and whatever else from Russia into Ukraine to mass up troops, to send them over. And, Russian troops have had a lot of military experience in the past 30 years. They've done operations in Syria, they've done operations in Chechnya, they've done operations in Dagestan, they've done operations in Kazakhstan. So you have a well-trained army going through land that is flat.
Mm-hmm.
Now, Taiwan is a mountainous region. It's a bunch of mountains that fall into the sea. The Taiwan peaks go as high as 12,000 feet.
Yeah.
And there's basically 100 miles of sea lane. Now, put things in perspective, France and Britain are separated by 6 miles. Now, the Wehrmacht, at the peak of its power, when it had overrun the whole of Europe, never felt, I'm going to cross the channel and invade Britain. They never even tried. And that was 6 miles. This is 100 miles.
Right.
And it's a bunch of mountains. Militarily, this would be a massive, with an army, a navy, and an air force that is completely untested, that has never, done any operations. And you're going to send them over the sea, a sea that is, by the way, prone to big seas. Like, you have storms all the time in the Taiwan Straits. You're going to send that over. That has potential disaster written all over it. Now, if you're Xi Jinping and you send that over, and it does turn out to be a disaster, not only it's your own head on the chopping block, but it could be the entire Chinese Communist Party. So, the risk reward on it. So the risk is enormous for them to do this, much more than Putin going into Russia. What's the reward? What you get out of it? What you get out of it is that the quarter of Taiwanese male passport holders that currently work in China probably leave China, and most of them in your key industries, in semiconductors, batteries, etc. You probably lose a lot of these guys. They fly off and they go to Japan, they go to Korea, they go to the US. It sets you back for a generation in terms of technological development. It also means that, ASML, Tokyo Electron, Samsung Electronics, all these guys probably stop sending you their semiconductors and their semiconductor equipment. So that sets you back further. Now, you might say, well, you gain TSMC on the other side, but you don't. TSMC will end up being a hole in the ground by the time you get there. And all the engineers, again, will be on planes for the US. So the risk reward is so skewed as to make no sense whatsoever. Now, to your point, what would be the response of the U.S.? I don't think the U.S. would go to war for Taiwan, especially so far away from its own shores,
Right.
were it to happen. So I actually don't think the U.S.'s response would be that dramatic, partly because it's easy for the U.S. to say, let's blockade Russia and let's bash Russia. The U.S. exports to Russia were roughly the same as Belgium's exports to Russia, i.e., very small. So economically speaking, for the U.S. to blockade Russia was whatever. But think of the corporate lobbying that would go on to not impose hard Chinese sanctions from Apple, from Tesla, from General Motors, from Procter and Gamble. I mean, you name it. So I don't think you'd see a war, but for me, all this talk of China invading Taiwan is really a way for the U.S. to justify its crazy military spending and building the next naval warship. Right. You look at the U.S., it spends more than the next 10 countries combined on its army, and nobody's ever going to invade the U.S.
Absolutely.
So you need to justify that somehow. So you need a boogeyman. Now, good thing is right now you have Russia, but you have two boogeymans out there, Russia and China.
Yeah. No, that makes sense. Moving on to the next thing that I wanted to talk about. I wanted to talk about QT, the Fed pivot, and what's going on with regards to inflation. So could you start off by talking a bit about how will QT play out, in the sense that we've barely seen the Fed start QT, and the other thing that we've observed is the July number that came out in August, so the month-on-month number was flat, and that caused a lot of commotion, and regardless of the year-on-year number, which is still extremely elevated. So do you think we're somewhere near a Fed pivot?
Let me put it, well, I'll see it when I believe it. I'll believe it when I see it. Call me St. Thomas. I want to feel those wounds on Jesus's hands and side. Look, the way I look at it is this U.S. CPI moved above the Fed's 2% target, visibly above it. It actually broke over 3% in March 2021, right? So over a year ago. The Fed continued expanding its balance sheet, regardless of what it was telling us, up until May 2022, so sort of 14 months later. Since then, indeed, to your point, it's flatlined its balance sheet. And now it tells us it's going to shrink its balance sheet. Now, the reality is the Fed may very well shrink its balance sheet, but then you're going to get to the big question of, okay, who's going to be buying all these government bonds and mortgage bonds that the Fed is supposed to be selling off? I guess maybe foreigners may buy them if you get a massive crisis outside of the U.S. Like, if all of Europe's savings decide I don't want to be here anymore because Europe is imploding. Right. That's one way I think the Fed could do QT. But failing that, I don't think the demand for the bonds is there. So you're going to end up with a bond market meltdown. And in time with the bond market meltdown, you'd get, I think the Fed will backtrack really quickly. So all this to say, I'll believe in the QT when I see it, and I think when it happens, it's likely to be fairly short-lived. I'll add one more point, is that the Fed balance sheet has been flatlining for whatever it is, 4 or 5 months, and at the same time, the cash balance of the U.S. Treasury was going down. The Treasury keeps more, basically as a checking account, and you can monitor it week by week. And you came into this year with a fair amount of cash in the checking account, and that cash has been brought down to basically its bare minimum. I think it's about $700 billion now, which corresponds to a week or two of spending. I can't remember the exact numbers, but you're basically at the lows now. As the Fed as the Treasury was, drawing down its checking account, this was adding liquidity into the system. So you had, maybe that helps explain the big rally we saw in parts of July and parts of August. Well, through July and August. But you're now in a situation where the checking account is running dry on the one hand, and on the other, the Fed is saying, "Well, I'm going to start shrinking."
Right.
If the Fed really does that, and the U.S. Treasury says, "Well, maybe I need to increase my checking account," that'll be a double liquidity drain. So we could get into a pretty dicey September, October, and September, October, November. So all this to say, if the Fed comes through with QT, I think we're in for a rough ride, and I think it'll back down pretty quickly. Or if they don't, then the U.S. dollar will be taking a hit, because part of the rally in the U.S. dollar today is this belief that the Fed is going to be tight, etc. If they don't if they don't follow through on all these promises, the U.S. dollar will roll over hard.
Yeah. And do you think that if the Fed doesn't commit, if the Fed ends up, say, not doing QT at all, do you think that would end up reducing future balance sheet capacities, in the sense that if in the future we end up with, say, some sort of an economic crisis, QE would end up being far less effective compared to what it would be if they actually did some amount of QT this cycle?
To be honest, I think whether they do QT or not is almost irrelevant. I think the outlook has now changed. Up until a year ago, the view was, we can print all the money we want. There's no inflation risk. Doesn't matter. So whenever there's a downturn, just print, and all is good. Now, all of a sudden, we know that, well, actually, when we do that, there is inflation. Turns out our Econ 101 from freshman year in college, turns out that was true. Lo and behold. And so with that in mind, I think the ability to wantonly do QE and not worry about the consequences, I think that's no longer really there. I think we've moved on. From now on, the question for most central bankers will be, do you do yield curve controls or not? And here, I'll just point out quickly, obviously, Japan is already doing yield curve controls. They've come out and said, look, we're not going to let long-dated yields move above 25 basis points because we need to fund our government. And everybody looks at Japan and say, well, these guys are crazy. These guys are nuts. Let's sell the yen until the BOJ changes its mind. I'll just point out that in my career, the BOJ has always been sort of a trailblazer. The BOJ was the first to do zero interest rates, and everybody said, "Oh, that's stupid. Zero interest rates, that makes no sense." And then a few years later, everybody had zero interest rates. And then the BOJ was the first to do QE, and everybody said, "Well, that's stupid." And then everybody pretty quickly was doing QE, and same with negative interest rates and so on. So now the BOJ is the first to do yield curve control. For me, the question is, how long until other central banks follow suit?
Yeah. And when it comes to a secular standpoint, are you on the secular inflation camp, or the secular sort of return to disinflation camp? Because I believe in another recent piece you sort of highlighted that, and I quote, if globalization was massively deflationary, deglobalization is going to be inflationary. And on top of that, we sort of have the dynamics of broad underinvestment in commodity production, etc. And to an extent, a heavier reliance on fiscal policy that we've sort of seen post the COVID-19 pandemic. And so, do you believe that from a secular standpoint, we are bound to see some inflation over the next, say, 8 to 10 years, or do you think
I do. I've been an inflationista for a while.
Yeah.
And I very much remain one, partly because I don't think in terms of either monetary or fiscal policy we've done that much to put the inflation genie back in the bottle, but also because indeed I think our economies are going through some important structural shifts that are fundamentally inflationary. For me, a massive shift occurred 4 years ago when the Chinese workforce started to shrink. For me, that was a big road sign. Another is indeed the deglobalization that you speak of. Everywhere you care to look around the world, in most developed countries, workforce are shrinking. So, unsurprisingly, labor costs are going up. I think to compensate for this, you would need massive productivity gains. But because we've had such good times for 20 years, I think we've done a lot of things that were actually, it's not that they were unproductive, it's that they were actually actively counterproductive. The whole green agenda, which is leading to greenflation, saying, okay, instead of using nuclear and coal and natural gas, we're going to punish those and reward wind that is, unreliable, much more expensive to put together. Turns out to actually not be that green, because disposing of these massive windmills is a complete disaster, so on and so forth. You look at that, you look at all across the Western world, all I would say the cultural agenda where you have to walk on eggshells to discuss any topic, lest you hurt somebody's feelings. It's not that that's non-productive; it's that it's actually massively unproductive. And so all this ends up with a price, and the price is higher inflation. So,
right,
it's the old story that good times create soft men create hard times create hard men, and hard men good times. And we've had the good times, and we're in the phase of the cycle where we've had good times that created soft men, and we now have hard times ahead. And hard is inflation, and dealing with inflation is going to be the political challenge for the coming decade, acknowledging that a higher inflation rate hurts the poorest the most. And you're seeing that already internationally. You're seeing it in Sri Lanka, you're seeing it in Pakistan, you're seeing it in Iraq right now, you're seeing it in Laos. It's the poor that are first and foremost hit by inflation. And we're seeing it internationally, and pretty soon we're going to see it in our own countries with riots, revolutions, whatever else.
Mm-hmm. I think the interesting point that you made was when you sort of discussed demographics and labor force. I think Mike Green has made the argument that what we're observing is, and you would agree with that we're observing that the labor force is starting to shrink. We're starting to see a demographic decline, just broadly speaking, and that would actually be where I think you would disagree is how that is actually an inflationary force, because typically when it comes to labor, what we observed, for example, in the 1970s was the baby boomers, the minorities, women. So those sort of three groups of people entered the workforce, and we observed this massive growth this massive boom in the labor force, and that was a huge part. Or at least I would argue that was a huge part of what led to the inflation in the 1970s. And we're sort of seeing the opposite of that, just structurally speaking, right now. So, why would a shrinking labor force actually amount to
So I know that's Mike's big thesis, and he and I have discussed this before, that basically the inflation of the 1970s was demographically driven. Now the interesting thing is, you were having these trends, women joining the workforce, the baby boomers joining the workforce. In other countries, you had them in Japan to some extent. You had it in Germany. You had it in Switzerland. But you didn't have massive inflation in those countries. Basically, the big difference between the US and, let's say, Japan, Germany, Switzerland, was that some countries monetized this demographic shock combined with the energy shock, and some didn't. And here what we've had various big shocks. The COVID shock, the energy shock, and some countries have monetized it and some haven't. China hasn't monetized it, and lo and behold, China doesn't have a massive rate of inflation. The US has monetized this. I mean, if you told me a year ago, look, Louis, a year from now, the DXY will be 20% higher than it is today, and US inflation rate will be 8.5%, I would have said, come on, it's either or, you know. It's either or. If you have 20% rise in the US dollar, everything the US imports is going to be cheap and US is going to be in deflation, etc. But here we are, right? Here we are. And why are we here? We're here partly because, frankly, the US is running out of workers. And the US is running out of workers for a number of reasons. One of them is demographic. The other is healthcare. You know, you have a lot of people in the US. If you look at today relative to 40, 50 years ago, you have a large part, you know, a non-insignificant percentage of the population that's not too obese to work. You know, it's 1.5%, 2% of the population. COVID also is wreaking havoc because if you have 1% of the population that has COVID at any one time and can't show up for work, that means that you need 1% more workers, and that creates, just for the redundancies, and that creates problems. You have the opioid epidemic, all these factors that are limiting the number of workers, and thus higher inflation. Now, you could say, well, the good news is it swings back the economic pendulum away from capital and towards workers. You know, it had gone so far in the interest of capital, in the interest of capital, that, you know, workers were getting a rough deal, and now, you know, maybe workers get a better deal, and so you're moving into this society, I think, where if you're hardworking and you have like two strong arms and you're willing to do a hard day's work, you know, things are looking pretty good for you right now. They're gonna look good for the coming years. If you're a retiree living on a fixed income, on a pension, then you're completely screwed. Which is, excuse my French, but which is anyway how inflation always ends up, is you screw over all the retirees. And you know, this is what we saw in Russia in the late 90s. By the late 90s in Russia, retired generals couldn't buy a loaf of bread with their weekly pension check. Generals of the Soviet army. And this is, you know, this is always how things end.
It's very interesting in the sense that we're sort of going to end up seeing some level of social instability, because in a way, when you look at the three most important prices for what you could call the common person, it would be food, energy, and then shelter or housing, and mostly food and energy. And when you start to see food and energy prices go out of control, you know, we've almost always seen some, you know, addition of revolts or revolution, some level of social unrest. So
no, we very well could. It all depends on your rates of inflation. Having said that, you know, the one silver lining to this very dark cloud is that if the people who end up being the most screwed over are the pensioners, the older folks, etc., you know, throwing stones at the police is a young man's game. 65-year-old people, they might demonstrate, they might protest, but they're not going to pick fights with the police. So you might see a rise in demonstrations, but these maybe won't be that violent. Let's say that's the silver lining to this crowd. So here again, it depends a lot on the countries, right? Because if you have a very young population, if you're Sri Lanka, and you have a very young population full of very angry 20 to 30-year-old males, then you get riots, then you get revolutions, then you get the storming of the presidential palaces we're seeing today in Baghdad. But in aging societies like Japan, like China, like a lot of the European societies, maybe that's not as big a risk as people imagine.
Yeah. Moving on, I wanted to, you know, go across the pond, go to Europe, and sort of talk about what's going on there, especially with respect to their energy markets. You know, so sort of the broad question that I wanted to ask was, you know, how would Europe handle the unfolding energy crisis?
I think there's, like, the only thing they can do at this stage is import large quantities of oil and burn oil to make electricity. And yes, it's not green, and yes, it's not that efficient, but in a short-term crisis. That's the only thing you can do now. The good news for Europe is oil relative to coal, oil relative to natural gas is actually quite cheap, at around $95. The other good news is moving oil around is easy. Well, I mean, is relatively easy. We know how to do that. You put it on tankers and then you put it on trucks or on rail. We're organized. People, like, systems are organized to do that. So I think that's what Europe will have to do. So when you look at the tremendous positive spread between natural gas and oil, or coal and oil, to me, everything seems destined for oil prices to come up. Now, the one bit I don't really get is the reason oil hasn't gone up a lot in the past 3 months in the face of this European energy crisis is, of course, that the U.S. has been releasing strategic petroleum reserves. Now, logically, the Europeans should have been buying these strategic petroleum reserves hand over fist. The U.S. should have said, okay, Europe, we're allies in this Ukraine thing. We're good friends. We're old friends. We're going to help you out of a bind. Here, you can buy our strategic petroleum reserves and we'll ship it over to you. That's what should have logically happened. Instead, good chunks of the strategic petroleum reserves are bought by China, which makes no sense.
Yeah.
Because China can buy the oil from Russia. So China is like, okay, well, I'll buy the Russian oil and I'll buy the SPR oil. Thank you very much. I'll take that off your hands as well. It's like, what are Europeans waiting for? It's like, the U.S. comes out and puts a for sale sign. Europeans should be, yes, I'll have it all. Thank you very much.
Right.
But not even doing that. So the lack of leadership, the lack of foresight amongst the European leadership is just, it's just infuriating. As a European, I'm French myself. Yeah. It's just infuriating.
Yeah.
I think when you look at Europe, the deal 25 years ago when the euro was put together and the whole EU was put together, it was, you give up your freedom on fiscal policy, you give up your freedom on monetary policy, you give up your freedom on energy policy, you'll end up with higher prosperity. But it's the old Benjamin Franklin quote, right? If you're given freedom for safety, you end up with neither. Europeans have given up everything, every policy lever. European countries have given up every policy lever to basically faceless bureaucrats in Brussels in the return for a promised prosperity that is completely MIA. It's it won't be found.
Yeah. Because the other thing that's interesting with the oil market right now is that, so when it comes to uses of oil, one is obviously importantly transport, but the second one from an industrial standpoint is mostly manufacturing. And for what it's worth, in the US, you've sort of seen industrial production and especially manufacturing start to slow down. Do you think that would end up being bearish for oil, because oil is in the face of that? If you came up to me and said, oil used to be $110 or $100, and then we're starting to see this big manufacturing slowdown. I would have said oil was probably 65, 70, but we're just not there yet. So how long do you think that sort of transmission mechanism is going to take place, if at all?
Well, that's what makes a market. I'll take the other side of that. I'm a big bull on oil, partly because I think Europe is heading into an energy crisis, and they'll need to buy oil, not so much to produce cars or widgets or whatever else, but just to keep warm this winter. Now, granted, partly depends how cold it is this winter, etc. But we Europeans have gotten used to taking warm showers in the morning, and it's not going to go down well if we can't in the middle of winter take a hot shower in the morning. That water will need to be heated one way or the other, and there's not 100 solutions. It'll have to be oil, unless, of course, gas starts flowing back from Russia. But that presupposes a sort of geopolitical development that seems highly unlikely right now. Look, when it comes to manufacturing, I do think what's going to end up happening in Europe is, as Europe runs the risk of running short of energy this winter, Europe will do what China did last summer, which is ration energy to the industrial users. You're not going to ration energy to the grandma in her apartment, risking freeze to death, you're going to tell the steel company or the auto company, sorry, you're producing only 1 week out of 2. Which actually brings us back to the inflation story. Is Europe is still key in a lot of industrial supply chains. Think of autos as the best example. The auto parts business is a massive business in Europe, and so what happens if this winter the auto parts business can't produce parts? Well, then you don't get cars.
Yeah.
The
And
old
so in a
story,
way,
right?
it's sort of regardless of it's sort of either industry can bear it or consumers can bear the brunt. And so if industry bears that, as you previously pointed out, we're going to see, as you mentioned, the shortages in say industrial production, in finished goods, etc. There's going to be more supply chain dislocation. But on the other hand, if the consumers work to bear it, we're going to end up seeing strikes, riots, etc.
It won't be the consumer. I think government will always picking on a few big businesses rather than the consumer. And you'd have to be mad to do it to it'd be political suicide.
Yep.
To impose it on that. So you're gonna impose it on businesses, of course. So they're gonna impose it on the businesses, and the old story, right? If a car is about 1,500 different parts, and if you have 1,490 parts, you've got a paperweight. And that's what it's going to be this winter for the European auto industry. So I think this winter you want to be long the US or the Japanese or the Korean automakers, but definitely not the European ones.
Got it. Yeah, no, that makes sense. And when it comes to the implications for the euro, we've seen the euro sell down all the way to parity. With this sort of idea in mind, where we're potentially going to see additional strikes, as well as supply, or your base case sort of being additional supply chain dislocations because of European automakers, European industries having to cut back production. What's headed for what's next for the euro? Do you think it goes even lower from here, or do you think the ECB is going to try and bring it up?
Forget the ECB. Like if the ECB wanted to do so, like inflation in Europe has already been, out of any critical zone, comfort zone. It's like, forget the ECB. They're not a player. They've already killed whatever credibility they had. No, look, I would say the one good news, as you scratch the potential good news on the euro, the one good news is that everybody's bearish, right? It's that's it. It's almost the ultimate contrarian play at this point, because indeed you have an energy crisis looming. You have strong risk of political crisis. Everything looks horrible in Europe. Just collapsing growth data. I mean, you name it, it looks bad. So, so the one good thing is, it's contrarian. I guess the other is that it's starting to get cheap. It's not massively cheap, but it's starting to get cheap. So, you could say, all right, well, if you end up with a mild winter, or if you end up with a positive result out of the Italian election, maybe the euro rallies. You could end up also with decent corporate profits for the big multinational groups, thanks indeed to the weak euro, which will help boost profits. But to be honest, I'm scratching the barrel here, because the euro story is, for me, it really is a poor risk reward. It's like, okay, maybe the euro can bounce 10%, yeah, because positioning is so extreme, etc. At the same time, if things go bad, the euro could literally implode. It could just stop existing. If the wrong party comes to power in Italy, if the Germans get upset that the ECB isn't doing anything, like, you can make lots of scenarios where things go really, really bad. So it's like, heads I win 10%, and tails I lose 50% or more. Why would I want to do that trade, right? Yeah. It's like, I'd rather move on and look elsewhere. So I'm not very keen to take a position either way on the euro, partly because the positioning is so extreme, but because fundamentally it just absolutely is. It's a miserable place. I'd much rather be in the yen, or in the renminbi, or in other emerging market currencies such as the Canadian dollar. There's other places where you can think of positive catalysts. if the Liberal Party of Canada ever gets its act together and throws out Trudeau, the Canadian dollar goes up 5% on that day alone.
Yeah. Or if Pierre Poilievre wins the election, that would be.
Well, I mean, anything that gets us rid of Trudeau, this thing rips higher.
Yep. Yeah, no, I completely agree. No, Louis, thank you so much for a wonderful interview. Before we wrap up, could you tell the audience more of where they can find you, your work, and your research?
Absolutely. Well, thanks. First, it was a pleasure meeting you. After hearing about you from Mike, I was delighted we could spend a bit of time together. So thanks for this. So the easiest is, we have a website called GaveKal. We also have a private wealth business called Evergreen GaveKal, where we actually have a free newsletter there. So if you want a free newsletter, sign up on Evergreen GaveKal for that. GaveKal, our website, is really for our institutional investors, whether on the money management front or the research side. Evergreen GaveKal is the private client side. I'm not really on social media. I do podcasts every now and then. So,
yep.
That's
Louis is a hard man to pin down. Yep. Louis, thank you so much for being on. It was fantastic talking to you.
Absolutely my pleasure.